Relief rally today on Wall Street. It was good to see after heavy selling that we had seen since late last week. Unofficially for the week, the S&P down 2.4%, the Nasdaq down 2.8%, and the Dow dropping 2.1%. But the Nasdaq good for a gain of 3.8% today, the S&P up 2.4%, and the Dow higher by 1.5%. So let's talk about these major indexes. Joining me now is William Huston, Chief Investment Officer at Bay Street Capital Holdings. William, thanks so much for coming on the show. What is your reaction to today's stock market rally?
It's good to see a Friday end on a positive note. The last 6 weeks at least have been rough but reasonable. So with all the volatility, I think we're seeing acceptable explanations, but also really glad to see the week end positive, although overall the market's still down.
So what is the outlook from here? I think a lot of people wondering, well, this is a great day. I mean, the Nasdaq was up nearly 4%. Should I get in right now? What do investors need to keep in mind? What's the best way to move forward?
Continue looking forward. Next week on the 17th, we're looking at retail sales as they come in. We already know that consumer sentiment is at a 10-year low. And with all of the uncertainty and volatility, that makes sense. But at the end of the day, I think people don't like being surprised at the checkout counter. I bought a bottle of Aveeno lotion for our son. I swiped it and it said $20. And my first thought was $20 for baby lotion. And I think that a lot of people might be having that same reaction as they're, spending money. And retail sales on the 17th is really going to see how the consumer is going to show us how the consumer has been reacting to the rising prices.
Question is, how did the Fed chair get this so wrong? I mean, up until the fall, the Fed was calling inflation transitory. Last week, the Fed chair said that he thinks we'll have a soft landing, and then just yesterday, entirely reversing course, saying he can't promise a soft landing. What is missing for the Fed right now to calm these markets and get the policy path set?
I think the market ran hotter than expected, even with the increase of 50 basis points that we expect to continue to see because, inflation is higher than desirable. At the end of the day, it was later than most people would have preferred. Prices have come up higher than expected, and we are expecting inflation to be here to stay for quite some time, especially, with the war going on, with the price of energy continuing to go up, with the continued COVID restrictions off and on, messing with the supply chain. So it's really just a function of typical supply and demand. The supply just isn't there. Demand is still high. It's higher than was expected. And we're seeing that across all sectors.
So what does this mean for the rest of the year, William? I think people also wondering, have we reached a bottom? Was the bottom on Wednesday in the stock market? And are we going to go up from here? What's your answer?
So you're right. I think we're on a thin line between bouncing back and then entering into, a bear market. After retail sales on the 17th, the following day, the 18th, we're going to see housing start. So that's going to give us some insight on how the housing market has been responding to the rise of interest rates. So I wouldn't try to look too far ahead. I would take this one day at a time, continue looking at the data, and then making sure from a portfolio standpoint, you're holding companies that fundamentally are sound investments. We like to tell folks that hope is not an investment strategy. So make sure with what you're holding, you've adjusted, you've got your cash position in place so that if we do go into that bear market territory, you're not reacting late. You're well positioned moving forward and just taking this one day at a time.
Okay, so another question that I have is clearly the economic data matters now, right? I mean, almost on a daily basis. Consumer prices soaring, stock market tanked. Producer prices soaring, stock market had a hard time absorbing those as well. So I think now maybe more than ever, William, this economic data really does seem to matter on a day-by-day basis. Is that going to dictate the path forward, these economic points that we get each day, and could that lead to more volatility?
Absolutely. I think the market is very smart. The retail investor is also looking at data that they didn't used to consider in the past. And as a result, again, we're looking for acceptable explanations. So as you mentioned, CPI data did come in higher, but it wasn't unreasonably higher. We were all hoping for something under that 8.2 mark. We came in at 8.3. The market opened high, on Wednesday, and then it came down as as we went into the market, and that's what really should have happened. So as we're moving forward on a day-to-day basis, absolutely, fundamentally, the economic data that we're looking at is important, and underneath that, the companies that make up these indexes, we really want to take a sharp look at what are the underlying holdings of these ETFs, of these mutual funds, and am I holding something that, from a value standpoint, accounting for where the decline has come? Are these companies still overvalued, or am I in a good position right now, regardless of what's happening moving forward for the long term?
So what are the percent chances, William, that we do reach a bear market, that we fall further from here? What's the risk-reward scenario?
I think it's likely based on the trend. That said, it's impossible to time the market. So for me to give a percentage would be, I would be lucky if I were right, and I would be unlucky if I were wrong. So what I would say is, I still think fundamentally the economy is strong. It's not surprising to see us come down from an all-time high. That's reasonable. We don't want to come into that 20% decline rate. Nobody wants to see that happen. But at the end of the day, if the numbers on Wednesday and Thursday and onwards don't look positive, that would not be, again, an unacceptable thing to experience moving forward. And investors should really be looking at, okay, if this happens, what is my current portfolio? Is it aligned with my long-term goals moving forward? And if not, adjust based on that, not necessarily based on some economic data that comes out next week.
Okay, so very quickly, as we watch each data point tick by tick, what are the positives that you see out there right now, William, other than the jobs market?
I still really like the housing market. Prices are coming down as rates have continued to come up, but we're not seeing any sort of, we'll say, like red flags in markets that are already strong. I do think that there are certain markets that have, again, they've just come up too high. Austin rates are extremely high. A lot of the rates in Arizona in terms of rent and purchase price are extremely high. So in certain markets like that, I do think that we'll see prices come down faster than others. But at the end of the day, the housing market is still very strong. Rates are up. It's making mortgages more expensive, but we haven't seen an unreasonable decline as it pertains to people actually purchasing homes. It's been more of what we've been expecting. So I think that's a good sign.
Okay, William Huston, Chief Investment Officer at Bay Street Capital Holdings. William, thank you so much.